late night, ain't getting no rest. Work so hard, people think I'm obsessed. Cream at the crop, won't settle for no less. Headed to the top, remaining so focused. Yeah, gorilla of the jungle, I've been beating on my chest. I learned from the struggle, it was all just a test.
Hey guys, welcome back. So today we're going to follow up on yesterday's video as well. We did get more kind of news around the retaliatory tariffs. I want to take a look at some macroeconomic numbers and really just kind of paint this picture for you guys. So basically what we saw all the tariffs getting released the other day, and then we've seen now that China has retaliated. So we've had some retaliations, we've had some negotiations. That being said, China is not ready to back down. It's exactly what I said would happen. I didn't expect them to back down. China has previously said they're ready to fight any sort of war with the US, including trade and tariff wars. They've also agreed to jointly react with Japan and South Korea. So we're going to wait and see if we get some more news from those two countries as well in regards to retaliatory tariffs. Just as they previously said, they would look at jointly responding. So we've seen China hit back with their own tariffs here. Basically, just weakness across the boards. We're seeing stock markets down, commodities down. So there's a flight from risk. It's odd because there's a flight from risk assets, but at the same time, silver and gold are being hit pretty hard alongside this correction as well. Things like the dollar aren't holding up as well as you would have thought. So I'm going to get into that. There is a little bit of reasoning behind that. Basically, as we see, potentially everyone is anticipating tariffs to disrupt the supply chains, which in turn raises costs and could threaten corporate profits. That being said, I don't think it's going to have an effect on corporate profits. Generally, the increased cost to import is passed on to the consumer, as I've mentioned previously. So while it might not affect corporate profits, it could spur inflation for the consumer. We see the US 10-year dropping, so that's also signaling that rush to safety. Investors are piling into bonds and safe haven assets, which is pushing yields lower. We also see here, essentially, if we see those yields continue below 4% sustainably, it might even be a signal of a recession with the other economic factors that we are getting. So ideally, a lot of people are saying this is pretty bullish. They want the US 10-year to come down. That being said, in the wrong kind of macro backdrop, it can actually be a bearish outcome. So we really need to pay attention to kind of everything going on in the macro sense, not just focusing on the 10-year or just focusing on the dollar. You know, it doesn't pay to just get fixated on a single metric or a single kind of data point that to build your thesis. We look at all the data we have available to us. We look at history. We look at the price action, the charts, and then we make up our minds how we're going to position ourselves for those potential scenarios, the general market dynamics. Basically, though, there is a lot of concern about U.S. economic growth taking a bigger hit than expected. So we've kind of seen the dollar not getting that same strength that I would have expected in such a major sell-off. When you see the stock markets down between 7 and 10% in 2 days, and the dollar's not gaining any strength at all, it kind of makes you wonder, where is that money going to, especially with gold coming down? So I'm going to flip over to the chart really quickly here, give you a little look here. So this is something I wanted to look at. You know, where is the dollar, or where is that money going to? So right here we have the Japanese yen overlaid on the US dollar. You can see right here, basically since in the lead up to the announcement of those tariffs, we were uptrending price action. So the Japanese yen gaining strength on the dollar, basically saying that investors aren't really looking to that US dollar for that flight to safety. And we can see this huge breakout up through here. So that kind of shows me, looking here, the dollar's up a little bit today, but look at that, it's still looking really weak. We still had this head and shoulders pattern basically play out. We're stuck under key resistance here. So weakness in the dollar, weakness in risk on assets, weakness in risk off assets as well. Look at this, gold, huge red candle right there. Silver down 5% on the day. Oil down 7.5% today. So just a huge dump across the board. And then we see the Japanese yen really doing well compared to the dollar. And we see the Swiss franc also doing very well compared to the dollar. You know what that tells me is that investors took that flight to safety but they didn't do it in the US dollar as they have previously. A lot of that could be reflected due to those concerns about a slowdown in the US economy, or it could just be that sour appetite from international investors around all these tariffs. You know, maybe just rather than taking that profit into the US dollar, they're going into other safe haven assets. So although it's not the reserve currency of the world, the Swiss franc is considered a safe haven reserve currency in my opinion. And then the Japanese yen is also one that's pretty commonly used by investors. We see basically this tariff and trade war escalation can cause inflation, and then inflation is going to cause the Fed to either continue staying in their stance of not cutting rates, or they're going to have to actually raise rates if inflation starts going back up to combat it. So that's kind of what we see. You know, basically the U.S. investors are a little bit weary about that. You know, they think that inflationary pressures could come as a result of these trade wars. It could put pressure on the U.S. dollar, and they're looking for those other opportunities to mitigate that risk outside the U.S. dollar. That's why I think the Swiss franc and the Japanese yen continue to outperform the dollar basically since the start of the year. So since Trump got in, the Japanese yen and the Swiss franc both outperforming the dollar by a long shot. We're going to flip back. I want to talk a little bit more about some of the macroeconomic numbers that I want to pay attention to. So we did get the Purchasing Managers Index, which is the PMI numbers. They are continuing to trend down, showing that slowing in manufacture and service sector. We basically see consumer confidence also trending down. So higher prices from tariffs, uncertainty about jobs and growth kind of makes households a little bit more uncertain. We see GDP projected negative for Q1 2025 as per the GDP Now model. So we'll see what happens. It's constantly revised. I'll flip back over here and show you here. This is the GDP Now model. So kind of just all over the place. It's going to get revised. So we're just going to keep following it kind of day to day, week to week, and then wait for those monthly estimates. But basically what you see now, we're projecting a minus 2.8% GDP based on this model. This model is historically very accurate. It's basically come within a very small percentage window of the actual print that materializes. That being said, this is going to fluctuate day to day, as I mentioned, so we'll watch it closer to the actual read. But it is interesting to note our GDP has dropped substantially and looks like we're in that negative GDP territory for Q1 2025. And we look at our United States manufacturing PMI. So on a 3-year basis, we're still higher than we were in 2022, 2023. That being said, look, we've kind of topped out and we're starting to trend down. We're now at 49, so we're below 50, which signals a contraction in the PMI or the manufacturing side of things. So just flipping back over here, we can also see that we're getting enough strength in the employment data. So we did get some employment data as well again today. So I'll flip over to that. We see we've got our jobs report here. So March jobs report adding 228,000 jobs. Unemployment is at 4.2%. So still kind of not a worrying in terms of unemployment, but kind of sticky unemployment there, right around at 4.2%. Ideally, we want to keep that lower. If we start to see that uptick towards 4.5% or higher, that's going to be another warning signal of that potential recession materializing. But we did see 228,000 jobs added, surpassing the expected growth of 135 to 140,000. So I still think the labor market is strong enough where the Fed doesn't need to cut rates. So we'll see kind of what happens. He's going to come out and have a talk today. That's Jerome Powell. So we'll see what he says in that. But based off of this information, based off of kind of the inflationary effect of tariffs, I don't expect him to make any changes. I still think maybe 1 rate cut by the end of the year, 2 if we're very lucky and all things kind of align perfectly. Or imperfectly, you know, in a bad case scenario where things really start to break down, we might get that additional rate cut. So just paying attention to that as well. Flipping back over here, as we'll see, we see China with their retaliatory tariffs. Say there's 34% tariffs there. So I'll show you over here. China imposing 34% tariffs on U.S. goods. So that is additional 34% in response starting on April 10th, and that's in retaliation retaliation. So we're going to see if we get kind of follow through with South Korea and Japan as they've previously stated. Basically, we could see this could lead to a tit for tat kind of scenario where the US and China are just going back and forth, tariffing each other. So it's going to cause a lot of uncertainty, a lot of volatility in the markets. It's why we've been sidelined. We've seen all the warning signals. We're not interested in buying into this crazy volatility, trying to figure out what's going to happen day to day. It's just kind of craziness. So we'll let the charts tell us what they're going to tell us, wait for that trend to show itself, and then we'll position ourselves in the trend. But basically, we're seeing that we could see oil prices start to slide. So yeah, we saw oil coming down quite a bit today. If we start to see gold really break out, that's kind of that supporting narrative of the safe haven, and then supports more of the recessionary aspect, especially if we continue to see strength in that Swiss franc and the Japanese yen. So basically, everything all together, it's just a market that's really gripped by this trade war fallout or this tariff fallout. So the biggest question is going to be what happens going forward. Do tariffs stick? Do they get negotiated down? Do they get retaliated against? I think it's going to be kind of mixed reactions across the board. We're going to see some negotiations. We're going to see some retaliations. I still think there's a lot of uncertainty and volatility in the markets, and for that reason, I'm just interested in looking at the charts, waiting for that trend, and entering when it makes sense, not buying into a downtrend. So we're going to flip over here. I want to take a look at our Treasury yield spread, because this is another signal of recessionary forces. So right here we've got the 10-year yield laid over the 2-year yield, and you can see almost every time that we've come back and uninverted this yield, that's signaled a recession. It doesn't materialize right away, so you can see right here we uninverted in January, but the recession didn't actually materialize until about March. Same thing here, uninverted in June and May, kind of around there. Recession didn't materialize until November. Right here it didn't. We didn't really invert. We inverted very briefly, uninverted, and then yeah, that recession materializing later on as well. So look here, this inversion that we had was a larger inversion than what we had in the dot-com era, what we had in the great financial crisis, and what we had during COVID. We're now inverted, so we have to really be careful. This is that technical warning sign that has previously marked many other recessions. We can also take a look at the 10-year and the 3-month just to get a more in-depth look at the kind of the lower time frame, and I'll zoom right in here to get a better idea. We can see just get nice and close. Pretty much we inverted, we come uninverted, reinverted, and then we're just chopping in through here. So we'll see on the lower time frame if this continues to trend back up to that uninversion, that's that warning signal. But the 10-year and the 2-year are flashing that warning signal for us. So we're going to take a little look here. We looked at the GDP, we looked at the PMI. Consumer confidence is trending down. We see kind of just weakness across the board in terms of stock markets. So what are the odds that there could be a recession in 2025? I'm going to flip over here. You know, I don't like to put too much weight into this. This is just a betting platform. So Polymarket, a betting platform, it's a representation of the population. It's a very small percentage, so obviously take it with a grain of salt. But we're starting to see major banks also coming out with 50-60% chances of a recession kind of in the next 12 months. So right here we're seeing just the market basically pricing in about a 56% chance that there is going to be a recession in 2025. So we need to pay attention to that, and then the recessionary factors that kind of come along with that. So that's that PMI trending down, consumer confidence trending down, and then that weakness in those risk on assets. So we'll continue following that. We're going to take a quick look at all the major markets here. We're just get a little idea of what's going on. So we looked at the dollar. We did break back below this trend line here. We're just coming into it as resistance. You know, ideally we want, if we can have the 10-year keep trending down while our other assets can kind of try to find a bit of a bottom and reverse, that would be ideal. You don't want this to be trending down with weakness across the board and further recessionary pressures kind of going in are involved. Looking here, we see the US 10-year coming down to that 786 level, and so just breaking down crazy here. We'll see. We'll probably get a little bit of relief, I would think. The VIX here, huge spike up. That's what I was warning you about. Watch for that break above 30, and that's exactly what we got. So we avoided all that volatility. Looking at the SPY, down another 3.5% today. This is insane, guys. Look at that chart. I'm going to pull up some of the indicators here. So we'll take a look at our directional movement index. We'll take a look at our MACD. We'll take a look at our Lux Algo Ultimate RSI. I'm going to take a look at volume, our VRVP, and then we will also take a look at our moving averages here. So we've got our ribbon and our simple. So just getting a good idea here, we're coming right into that daily point of control on the VRVP. So you can see this large volume bar. That being said, we're getting that uptick in sellers, huge bearish momentum, bearish cross, bearish cross. So just bearish on the daily here. We're stuck under the 50-day and the 200-day. We'll pull up our shorter term moving averages. So we pull our 8-day and our 21-day, and we can see, all our major moving averages stacked on top of price and angled down. That's a really bearish setup. I'm not really liking that too much. Where I'm looking for the potential to get a good entry in the SPY, looking at kind of the 510 area, I believe, or maybe it's sub 500. But essentially all I'm going to do, pull my Fibonacci from this swing to this swing here. So looking at 512, we get to that 0.5 Fibonacci zone. Even here, it's not a bad place to be buying the SPY on a long-term basis if you're dollar cost averaging. We can see that we're probably about 15, almost 16% off the highs. So a broad market correction in the SPY is generally about 15 to 25%. A really bad recessionary correction can be 30 to 40%, but based on history, it makes sense to be adding the SPY if you can afford to do so and it's within your risk tolerance at these kind of valuations off of the highs. That being said, just recognize this is that downtrend price action. We can always go lower. My personal targets for accumulation are further down here in this Fibonacci golden zone around that 200-week moving average. So when we do hit here, if we get there, I'm going to probably make a little DCA purchase into my SPY position, just because of something we saw in this prior rally over here. So when we saw this move to this move, this move to this move, we came back and retraced that 0.5 Fibonacci, bouncing from there. So that's what I'm looking to kind of do over here. Start buying into the position here and then dynamically DCAing into these lower targets down here. So that's the plan for the SPY, just still sitting on my hands waiting. We see the NASDAQ just down like crazy with that horrible bearish price action. This is probably down 20% off the highs, I would think. 20%. So same thing as the other one, guys. Like, it's worth it to DCA if that's within your risk profile and you have a long enough time horizon, but you need to recognize that potential for more downwards price action. As a TA guy or like a chart guy, I'm going to wait for those lower targets to hit. I'm going to start entering positions, and then when that trend actually changes and confirms to the upside, that's when I'm going to start putting in substantial more amounts of money, more of that lump sum territory, and taking advantage of the trend. We can see the Dow Jones down 3%, same thing, very similar setup. IWM down 5.5% today. This is another one of those recessionary warning signals. We almost started to see the IWM really showing a tiny bit of relative strength in through here, but ultimately rejected by those low time frame moving averages, stuck under the VRVP point of control and showing a lot more weakness relative to the major indices here, kind of showing me that there's more broad market weakness and these companies aren't able to prop it up like they were before. TLT up 2% today. Look at that, guys. So our TLT position is doing fine. That's what I talk about, hedging your positions. We kind of expected this potential scenario to play out, and then in this recessionary or risk-off environment, things like TLT go on to outperform. So we de-risked our other positions at near the highs, and then we reopened hedged positions that perform well in the opposite environment. So now not only do we protect our capital to the upside. We found some nice hedged positions. We're sitting in good profits, and we're continuing to hold those. We're above that VRVP point of control. We're above all our major moving averages with them turned up. TLT is looking good. Gold down here today with a little bit of a correction, so we'll see if we can find some support. You know, it still could come down to about $3,000 and hold those macro higher lows. Silver here also coming down about 5%, went right up into resistance, just shy of resistance. So I did mention this as a selling target potentially for silver. You know, we came within a fraction of a percent of it. That's when I talk about that margin of error. If you have a sell target of let's say $31.50 and the price goes to $31.40 and you're not willing to take those profits, you kind of deserve to get caught on the downside move. I know it's hard to hear, but that's when I'm talking about greed. Have a little bit of a margin of error, whether it's a percent or two. If you get within your target buys or sells, then it makes technical sense to do so. Don't be afraid to take profits, book those, and then we can look to reinvest those elsewhere, take advantage of the opportunities. Oil down here quite a bit, 8% today, just breaking way below this trend line here. It's actually ideal for inflationary pressures. Same thing seeing nat gas come down, although it's still up here kind of in these range highs. It is kind of help fight off the inflationary effect of these tariffs. Just so across the board, really mixed results. You know, most everything is showing weakness. Some more recessionary signals kind of coming into the mix. We can take a look at Bitcoin here real quick. We see nothing really to write home about. We're still consolidating in this bear flag pattern, stuck under the resistance, and our death cross is looking more and more likely every day. So not a lot going on, guys. I continue to sit on my hands. There is opportunity to be DCAing into the market, but ultimately I want to wait for it to bottom, reverse that trend to the upside. We'll get in our positions and we'll ride that trend until it makes sense to take those profits and get out, and then we'll just rinse and repeat over and over. Same thing, we do it across any asset class. That's why we learn these tools, these strategies. You can really just take them and apply them anywhere that you are investing. So thank you so much for watching, guys. Please like, share, subscribe. It all means the world to me, and I'll see you in the next one.